Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 7.88% year to date as of July 29th, 2023. Our goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor, but we are not accomplishing our goal. I sound like a broken record. I don't like that, but it is what it is. I have a strategy and I'm sticking to it. And right now I need the market to pull back in order for my strategy to be profitable. The next 3 months are the summer doldrums. So hopefully the market will have that 5 to 10% pullback that it usually has every year. So that is the expectation. The buy and hold investor is up 19.33% year to date. We are up 7.88% year to date. Here are some past returns. In 2022, our portfolio returned 21% compared to the S&P 500, down 19%. And here's 2021 and 2020, doubling the portfolio. If you want to see how I do that, go ahead and hit that subscribe button, ring that bell, and smash that like button down. Thank you. Last week, the S&P 500 for the week gained 1.05%. Now, here is a trade that I closed out on July 21 is when the announcement went out. We had a long call option and we ended up selling our 490 call and we sold it at 1507. Well, the market has advanced since that sell price, and we could have sold it during last week for approximately $17.95. So we sold it for $3,014. We could have sold it for $35.90. So we left some money on the table there with that sell. But I wanted to be conservative and I wanted to take that profit when I saw it. Here are some trades for 2023 of the model portfolio. If you want to see all of my trades going back for the last 3 years, you can head over to spytradernow.com. There will be a link down below for spytradernow.com, as well as all of the different slides I'm going to present in this presentation. Here is the equity curve for the model portfolio year to date 2023. Here is the equity curve for the buy and hold investor for year to date 2023. And here are the two equity curves combined, because we always want to compare ourselves against the benchmark S&P 500. You can see it's just been unrelentless with them, and I'm looking for that pullback so we can get back in going long, and it has not happened yet. Hopefully it will happen in the next 3 months. Last week, the Fed Chair Jerome Powell increased interest rates by 25 basis points, bringing the federal funds rate to 5.25 to 5.5% on July 26th. The Fed chair made an announcement that it said it will continue to assess the macroeconomic and fiscal backdrop, signaling further rate hikes may be on the horizon. Well, probably they're going to have at least one more 25 basis point rate hike. Now, the next Fed announcement will be on September 20th. My personal guess at this point in time is that the Fed is going to skip this one because he just did that one. And then come November 1, he'll evaluate the situation to see if he wants to do 25 more basis points at that time. But inflation, he still wants to tame inflation down, and unemployment rates are still very low, giving him the leeway to go ahead and make these increases. Now we are looking at things from the presidential election cycle theory, which states depending upon what year of the election the president is in, will determine the historical rate of returns for the stock market. Currently, President Biden is in his third year, 2023. Historically, that averages 16.3%. Well, the buy and hold investor is currently at 19.33. So we are beating the historical average by about 3 percentage points. So we want to, so they're a little top heavy on this. So there's definitely clearly room for a pullback here and still be within this historical norm. Now we are looking at things from the bond market. And the bond market, a lot of people say, are smarter than the stock market. The bond market currently has an inverted yield curve and we have rising interest rates. These two things combined are telling us that we should really not be equity investors during this time for the ultra conservative investor. So that's how the bond market, that's what it's telling us. Now we are looking at things from a valuation according to CMV, which is current market valuation, link here and down below. Currently the market is overvalued by the historical average. The PE ratio is at 31 compared to the 10-year average of 20.2. On a standard deviation chart, that brings us to 1.4 standard deviations. So definitely we have risk in this market. And now we are looking at the Fear and Greed Index by CNN Business. Here is our friend Warren Buffett, and we are in extreme greed currently. We did come down a little bit since 1 week ago, 82. Now we are at 78. Now we are looking at things from a seasonality outlook. Going back 20 years, S&P 500 monthly in the month of July, our current month, where there is only one more trading day left, there is a 70% probability we will close higher than when it opened. Well, currently the month is up 3.08%. Here is the bar for the month, one more trading day. Looks like we're easily going to accomplish this goal of 70% unless we have a greater than 3% correction on the next trading day, Monday, but I highly doubt that will happen. Now, looking at the seasonality, the next 3 months are the summer doldrums, 63% probability. During this time frame, one of these 3 months, I am expecting a pullback. That is my expectation. Just because I have an expectation doesn't mean that that's what the market will do, because the market will do whatever it wants to do whenever it wants to. Now we are looking at things from a long-term outlook. This is a monthly chart for the S&P 500 going back 20 years of data. Long bull run, 2009 all the way to 2022. Downward correction, broke out, never looked back. This particular angle is unsustainable. This will pull back eventually. It's not going to just continue to go up. We will have one of these or one of these or one of these. And this is where we want to gain our entry and go long and put more leverage to work. This is what we're waiting for, a little bit of a pullback. So we're just waiting for that pullback to happen. This chart is positive though, from a long-term outlook. MACD positive, slow stochastics positive. So far, so good. Now we are looking at an intermediate term outlook. This is going back 5 years, weekly bars or candlesticks for this particular chart. We have just broken above this old high right here, and now we have entered this new trading range right here for just a few days. And we've closed into this range about 2 days. So we have to see how this what happens here. But now we're getting ready to enter the summer doldrums. You know, are we going to get a pullback? I'm going to leave this downside projected target here until we break this old high and close above it. Now we're looking at a very short-term outlook. This is a 6-month chart, S&P 500, and here you can see those trading ranges, and here where we broke above it, but here on this chart it looks like we're kind of hitting a ceiling. And we even have this downward candle right here. Need a few more days of action to see what's going to happen here. But as long as we stay in this channel, we are clearly on a bull run right now. Once we break out of this channel, we need to see what's going to happen, sideways movement or downward movement. Right now we have a negative divergence on this 6-month chart. So you can see here on the MACD, you've got a negative high here and a positive high on the actual candlesticks. That's a negative divergence. Now we are looking at a ratio chart with the equal weighted S&P 500 compared to the normally weighted S&P 500. There are 3 charts here in one chart. The one ratio chart is the one with the red and black lines. The green is the equally weighted S&P 500. The blue is the normally weighted S&P 500. The bull run from 2009 to 2022, most of that time, the equally weighted S&P 500 outperformed slightly the normally weighted S&P 500. In the last 20 years, we've fallen off of a cliff 3 times on the ratio chart. And the most recent one is this one that we just currently bottomed from. The MACD has gone into this, below this line here, only 3 times in 20 years. And right now we are experiencing one of those times. Every time in the past 20 years, after the MACD has gone positive, a short term later, here there was a little bit more downside correction for the S&P 500 before it began its long-term bull run. But here on this particular one, the bull run just started immediately on the crossover. So I'm expecting or looking for a little bit more of a pullback here. The biggest concern with this chart is that in the last 3 times where you see the MACD fall into this level, the S&P 500 has also taken a dive here and taken a hit here. But here in 2023, absolutely no hit. So if this hit is going to come, that punch can come very powerfully, and that's a little bit of a concern. And with our valuations being the way that they're at, there's a caution advised here. But so it would be so healthy for this market to have the pullback, come in, and then take off. And then we could feel more comfortable going along. Now we are looking at the VIX, which is the volatility index, the fear index. Right now, we were in this low range. We dropped below that low range. Now we're in this ultra low range, been moving sideways ever since. So we are, if as long as we continue to move sideways like this, the S&P 500 most likely is going to advance, just like it has been doing. You can see this is the S&P 500 in the black line. When we came into this low range right here, and you look at that chart, it's just been slowly and steadily going up. It's going to continue to do that if we stay in this range. So we're monitoring this closely. Now we are looking at the Think or Swim platform where we can see standard deviations. This is a 1-year chart. It's a bullish chart. You can see that we've got a nice ascending formation going. So if you look at the left-hand side compared to the right-hand side, we're moving up, which is the way you want to be moving to be making progress. My 460 mark never got hit, but it came really close right there. And over here, we see the low mark that I'm trying to have the market pull into so I can close out of my my option, so I can close my covered call and then hold the stock, possibly take on some leverage and then look for some gains. But we're watching to see how this market plays out. But I want you to notice where we are on the standard deviations. On the 1-year chart, you're at the approximately 1.3 standard deviation. Now you're looking at a 6-month chart, but here you're only at a 0.7 standard deviation. And when you go to the 3-month chart, you're only at a 0. You're right at the midpoint regression line on the 3-month chart, meaning that you can go in either direction on this very short-term 3-month chart. So taking a position and going long and looking at this chart gives you some room for advancement. You can go from our current level of 456 up to somewhere between 471 and 487 before coming into that +1, +2 standard deviation chart. But the longer the chart is, the more accurate the standard deviation lines are. So you want to give the standard deviation lines more credence on the longer term charts compared to the shorter term charts because it's taking in more data. So in this particular case, we can go up to 472 before touching the +2 standard deviation. And on the 3-month chart, 472 comes in at just about the +1 standard deviation. So we could take and do a little bit of I'm very strongly considering taking 3 call options, long call options, and closing them out once we hit the +1 standard deviation on this chart. Okay, I've just given you a ton of information in this presentation. Now comes the critical thinking. What are we going to do with that information? Well, as of July 29th, 2023, the market summation, according to me, Ken, with SPY Trader Now, is that all I have to do is wait and watch. I already have my positions in place. This is pretty much rinse and repeat from last week, because I put out a call that doesn't have an expiration date until 8/4/23. So I still have that position in place. I'm just going to sit tight and watch the market. But generally speaking, my expectation is that the market is going to have a pullback within the next 1 to 3 months, and during that time, my current expectation at the way the market is looking right now is that we will close out that call position. We will continue to sell covered calls against our position until we can close it out. In the meantime, if the market's going to continue to advance, we'll take out another small position on a long call, and we'll just try to ride that out for a little bit of profit, as I just showed you within this presentation. So that's it. I hope you have gotten some valuable information out of this video. If you have not done so already, go ahead and hit that subscribe button, and also ring that bell to be notified, and smash that like button down to help me promote this video. I thank you, and I wish you good trading.